welcome to the deep dive. Imagine packing up a traditional, heavy machinery mining company on a Friday, and by Monday, you've decided to become the central bank for a digital economy.
Yeah, that is quite the weekend.
Right. Usually when we look at a corporate pivot, it is something measured, like a legacy car manufacturer rolling out a few electric vehicles over, say, a 5-year timeline.
Right, or traditional software company slowly moving its services to the cloud. It's cautious.
Exactly. It's designed to keep investors calm and steady.
And that caution is entirely by design. I mean, it's like steering a massive cargo ship. You turn the wheel, but it takes miles for the vessel to actually, change direction. You really don't want to upset the cargo.
But today, we're looking at a pivot that is, well, it's less like steering a cargo ship and more like strapping rockets to the hull and launching it directly into orbit.
Yeah, that's an understatement.
We are diving into a company that essentially woke up one day, stopped its core operations, and aggressively restructured its entire reason for existing. Today, we're looking at Bitmine Immersion Technologies, trading under the ticker BMNR.
A truly fascinating case study.
Our mission for you today is to really understand the scale of this company's radical transformation, from a traditional Bitcoin miner into the absolute largest corporate Ethereum treasury on the planet.
And the numbers are just staggering.
They really are. So we're drawing from a stack of financial filings, market analytics, live ticker data, and recent analyst reports to figure out exactly why their stock is trading at this steep discount to their actual assets.
Yeah, that disconnect is key.
And we also want to uncover what kind of high-stakes structural risks are hiding beneath the surface here. So, okay, let's unpack this. How does a standard Bitcoin mining company just pivot into something this radically different without the wheels coming completely off?
It is a phenomenal shift in corporate strategy, and you're right to point out how abrupt it feels, because it is. Bitmine Immersion Technologies didn't just, dip their toes into a new asset class to diversify a little.
Right, it wasn't just a side project.
No, they completely overhauled their balance sheet. To understand the scale of this, you really have to look at their current physical and digital holdings. According to the latest data we have, BMNR holds 5.79 million Ethereum tokens.
5.79 million. Wow.
Yeah. And alongside that, they have a smaller reserve of about 208 Bitcoin, $180 million allocated in strategic stakes and other ventures, and about $268 million in traditional cash and marketable securities.
Okay, so when you tally all of that up, what are we looking at?
You are looking at a total asset pool standing just north of $11.6 billion.
$11.6 billion.
But honestly, the most striking part of this isn't even the dollar value itself. It is the raw market share they've managed to capture. By holding that 5.79 million Ethereum, BMNR now controls 4.8% of the total global Ethereum supply.
That number, that requires some serious context. Nearly 5% of the entire global supply of a major cryptocurrency.
It's massive.
To put that into perspective for you listening, it's like a traditional gold mining company suddenly deciding to stop digging in the dirt, packing up all their heavy machinery, and somehow, acquiring 5% of all the silver currently sitting above ground on Earth.
That's a really good way to visualize it.
They are effectively acting as a decentralized reserve bank. But that brings up a glaring logistical question for me. If a single corporate entity quietly tries to corner nearly 5% of a globally traded asset, how do they physically execute that?
Right, without blowing up the market.
Exactly. Why didn't that trigger a massive market panic or send the price of Ethereum through the roof while they were buying it all up?
What's fascinating here is the strategy of execution and really the power of institutional accumulation. You don't acquire 5% of a global network overnight by just logging into a retail exchange and clicking buy.
I'd imagine that would break the system.
Oh, absolutely. If you tried that, you'd experience what's called slippage, meaning your own massive buy orders would drive the price up against you, making every subsequent token you buy way more expensive.
So how do they do it?
Instead, BMNR utilized what we call over-the-counter, or OTC, desks and institutional dark pools.
Dark pools. Sounds mysterious.
It does, but they're basically private trading venues where large buyers and sellers are matched directly without broadcasting their trades to the public order books in real time.
Oh, I see. So the rest of the market doesn't even see it happening.
Exactly. This allows a company to conduct a sustained accumulation phase over months, quietly absorbing liquidity without causing a retail panic or, creating a giant green candle on the price charts.
Makes sense.
And by moving first and at such an unprecedented scale, BMNR has built a competitive moat that is practically insurmountable for any traditional finance company trying to enter the space now.
So they essentially built a wall around their market position just by being early and buying quietly.
Exactly. In the crypto ecosystem, scale isn't just about how much wealth you have on paper. It's intrinsically tied to network security and influence.
Because they hold the tokens.
Right. Because they hold so much of the supply, they inherently control a significant portion of the network's validation power. If a traditional Wall Street bank wanted to replicate BMNR's Treasury today, they would have to buy in at current, much higher market prices.
Which would cost a fortune.
A massive fortune, and it would likely face severe regulatory scrutiny, making the barrier to entry incredibly high.
Okay, I follow the logic on the accumulation. They've built this multi-billion-dollar digital fortress, and hoarding these tokens looks, beautiful on a quarterly balance sheet.
It certainly does.
But here's where I get tripped up. If you just have billions of dollars of digital assets sitting in a vault, how are you keeping lights on?
That's the billion-dollar question.
Right. I mean, how do you pay your executive staff, your engineers, your server costs? A treasury doesn't magically generate real-world cash flow just by existing. So how is BMNR actually monetizing this hoard of Ethereum?
That is the crucial pivot point where their new operational model comes into play. They aren't just letting the Ethereum sit idle in cold storage. They're actually putting it to work through a newly launched infrastructure division called MAVAN. Yeah, which stands for the Made in America Validator Network.
Great. Break that down for us. What exactly is a validator network?
To understand MAVAN, we have to look at how Ethereum operates. Unlike Bitcoin, which uses proof of work where miners use high-powered computers to solve math problems.
Which takes a ton of energy, right?
Exactly. Ethereum uses something called proof of stake. In a proof of stake ecosystem, you lock up or stake your own tokens to help secure the network, verify transactions, and create new blocks.
So the tokens themselves are doing the work.
Yes. And in exchange for providing that security and locking up your capital, the Ethereum network pays you a programmatic yield. It's basically an interest rate paid out in more Ethereum.
Oh, wow.
By launching Maven, BMNR has essentially turned their static treasury into a high-capacity, yield-generating engine. And the financial results of this shift are highly irregular for a standard company. They are reporting a 1,022.3% year-over-year increase in trailing 12-month revenue.
Wait, hold on. 1,000% revenue growth in a single year. That is a metric you usually only see in typos.
I know, it sounds fake.
How is that functionally possible?
Well, it happens when you transition from zero operational revenue to a fully deployed multi-billion-dollar staking operation. In their most recent quarter, they generated approximately $46.5 million in total revenue just from these staking rewards.
$46 million in a quarter.
Yeah, but here is the critical part. Because staking doesn't require massive global supply chains, sprawling factories, or physical inventory, their gross margin stands at an exceptionally robust 83.48%.
I want to pause there because I really need you to explain the why behind that margin. Why is staking so incredibly cheap to run compared to their old business of Bitcoin mining?
It all comes down to hardware decay and electricity. When BMNR was a Bitcoin miner, they had to constantly purchase highly specialized, incredibly expensive computer servers called ASICs.
Which burn out fast, right?
Right. Those machines run incredibly hot, consume vast amounts of electricity, and they basically become technologically obsolete in about 2 to 3 years. You're constantly fighting depreciation.
It's a treadmill.
A very expensive treadmill. But with Ethereum staking, the hardware doing the heavy lifting is actually the capital itself, the locked-up Ethereum. The physical servers required to run a validator node are relatively standard, off-the-shelf enterprise machines.
Oh, so you don't need supercomputers anymore.
Not at all. The electricity cost is a fraction of Bitcoin mining. Your overhead is essentially just server maintenance, bandwidth, and cybersecurity. That lack of hardware decay is exactly why they can hit an 83% gross margin.
That's incredible.
And looking ahead, BMNR is projecting $254 million in annualized staking revenue. And that's based on a pretty conservative 2.65% yield on their current holdings.
So they're swimming in cash flow.
Basically. To give you a sense of how safe that makes their corporate structure, that gross staking forecast covers their preferred dividend obligations, which are about to 5 million by roughly 7.6 times.
So it's kind of like owning a sprawling plot of prime real estate in Manhattan.
Good analogy.
Instead of just sitting on the empty dirt, paying taxes, and waiting for property values to rise over the next decade, you just pave it, turn it into a high-yield mega parking lot, and collect cash from it every single day with incredibly low overhead. That makes intuitive sense. But I need you to help me square a very sharp circle here because I'm looking at two numbers in these filings that are completely short-circuiting my brain.
Oh, lay it on me.
If they're printing $46.5 million a quarter with cozy 83% gross margins, why did they report a net loss of $83.6 million last quarter
Yeah.
and a negative EBITDA of $79.1 million? On paper, those look like the numbers of a business in a complete death spiral.
I understand exactly why that looks contradictory on a headline, but we have to pull back the curtain on how accounting rules force companies to treat digital assets. Let's start with EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization.
Right.
It is a metric used to gauge a company's core operational profitability before accounting tricks are applied. BMNR's negative EBITDA and massive net loss are predominantly paper losses.
Paper losses.
Yeah. They are a function of non-cash digital asset revaluations, specifically what's called mark-to-market accounting.
Meaning they get penalized on paper if the price of Ethereum drops, even if their business operations are totally fine.
Precisely. Under current accounting standards, if BMNR holds 5.79 million Ethereum tokens, and the open market price of Ethereum drops by, say, $200 right at the end of the financial quarter.
Which happens in crypto all the time.
Exactly. The company is legally required to record that drop as a massive financial loss on their income statement. This happens even if they haven't sold a single token and their staking servers are running perfectly.
Wow.
It looks like they lost millions of dollars in cash, but in reality, it's just the fluctuating value of their inventory. And then you add to that the heavy one-time capital expenditures they are currently deploying to build out the physical server racks and data centers for the Maven network. And your bottom line net income takes a severe but temporary hit.
Ah, okay. So it's an accounting quirk mixed with aggressive one-time setup costs for the new infrastructure.
Yep.
It's not that the staking business model itself is failing to generate cash.
Exactly. You really have to look past the income statement and look at their liquidity to gauge their real financial health. Their balance sheet is uniquely structured. BMNR's liabilities are incredibly minimal.
How minimal are we talking?
We're talking about current liabilities, so bills they have to pay in the short term of only $12.1 million, stacked up against billions in assets.
12 million against billions.
Right. Look at their current ratio. The current ratio measures a company's ability to pay its short-term obligations with its short-term assets. A healthy, traditional tech company might have a current ratio of 1.5 or 2, meaning they have twice as much cash as they have short-term debt.
Okay, what is BMNR's?
BMNR is sitting at a current ratio of over 30.
Over 30. Okay, well, if their profit margins are sitting at a cozy 83% and they have a current ratio of 30, the stock price should naturally be soaring.
You would think so.
But it's not. It's actually in a state of free fall. What is the open market seeing that the balance sheet isn't showing us? Let's talk about the price disconnect.
The contrast between the balance sheet and the stock chart is definitely sharp. As of our latest data, BMNR stock recently closed at $17.28.
Ouch.
Yeah, that is down nearly 76% from its 52-week high of $71.74.
That is a brutal drop.
It is down over 16% just over the last 13 weeks, and nearly 38% over the last 26 weeks. It is undeniably in a painful technical downtrend.
Yeah, the trend is not their friend right now.
But the key metric we need to focus on here is the price-to-book ratio, or P/B ratio, which currently sits at 0.8986.
For those who might not live and breathe financial modeling, let's define that. A price-to-book ratio under 1 essentially means the stock is trading for less than the liquidation value of its actual assets. It means if a company has a jar with $10 in it, the stock market is currently valuing that entire company at $8.90. If you buy a share of BMNR right now, you are effectively buying a dollar's worth of Ethereum and corporate cash for roughly 89 cents.
That is a perfect way to explain it. It indicates the stock is trading at a discount to its net asset value, or NAV. And this specific discount has created a fascinating battleground between institutional sellers and corporate management.
A battleground. I like that.
On one side, you have major institutional holders like ARK Invest, Cathie Wood's prominent innovation fund, actively trimming their BMNR position.
Oh, Cathie Wood is selling.
Yes, they are steadily rotating their capital out of BMNR and into other crypto-related assets like Coinbase and Circle. That sustained institutional selling pressure is a primary reason why the stock price has been pushed down so hard, creating this NAV discount.
So what does this all mean? I have to push you on this because the logic feels broken here.
Let's hear it.
If the math objectively says investors can buy $1 worth of underlying, highly liquid assets for 89 cents, why are major, highly sophisticated institutional players like ARK Invest running for the exits?
It's a fair question.
If I'm looking at Cathie Wood dumping her shares, my instinct says she's found a structural flaw in Mavan's staking setup. Is ARK seeing a technical ceiling here, or is this just standard portfolio rebalancing?
If we connect this to the bigger picture, it's highly likely to be the latter. It is less about a fundamental flaw in BMNR's architecture and much more about institutional portfolio management and risk rotation.
Risk rotation, right.
ARK Invest manages billions of dollars, and they have to constantly adjust their exposure based on macro trends. They might be rotating into assets with more established regulatory clarity in the US, like Coinbase, or looking for different beta profiles.
Beta meaning volatility.
Beta simply measures how much a particular stock swings in price compared to the broader market,
Yeah.
If ARK wants to reduce their extreme volatility exposure, BMNR is a prime candidate to trim.
That makes sense.
But what is truly telling isn't why ARK is selling, it's how BMNR's internal management is reacting to this institutional selling.
How are they reacting?
They aren't issuing PR statements to beg investors to stay. They are fighting back with one of the most aggressive corporate maneuvers possible, a $4 billion stock buyback program.
$4 billion. That isn't just a token effort to prop up a struggling stock price. That is a massive deployment of capital. Walk us through how a buyback like that actually works mathematically.
Since July 1st alone, Bitmine has repurchased 11.6 million shares of their own common stock from the open market. This represents the largest common stock buyback for any digital asset treasury in history.
Wow.
When management buys back their own stock while it is trading at a discount to net asset value, it is mathematically accretive to the remaining shareholders. Right. Accretive means it fundamentally increases the value of what's left. Think of it like a pizza. If the company buys back slices and retires them, your remaining slice represents a larger overall percentage of the underlying Ethereum treasury.
Oh, I like the pizza analogy.
Management is essentially using their cash reserves to buy Ethereum at a discount through their own stock. They have explicitly stated in the filings that they are increasing these buybacks because they view the rising ETH to BTC ratio, which is currently at a 3-month high, as a major macroeconomic sign of strength for Ethereum moving forward.
So they see a bull market coming.
By buying billions in stock, they are trying to forcefully close that NAV discount gap and force the market to price them fairly.
Putting $4 billion on the line to buy back your own stock definitely shows immense, unshakable internal confidence.
It really does.
But relying so heavily on a single, historically volatile digital asset leaves the company exposed to catastrophic existential risks. Which brings us to the elephant in the room. Here's where it gets really interesting.
Let's talk about the risks.
Is this whole thing a leveraged house of cards? Let's talk about the extreme downside risks of running a balance sheet this heavily weighted in crypto.
The risk profile here is entirely unique to the digital asset space. BMNR's most significant vulnerability is its extreme leverage sensitivity to the spot price of Ethereum.
Because they own so much of it.
Because their treasury is so large, the leverage works intensely in both directions. According to the sensitivity analysis in the filings, a mere $100 swing in the price of Ethereum changes BMNR's gross treasury value by $579 million.
Okay, let's unpack that, because a $100 move in Ethereum isn't rare. It happens on a random Tuesday afternoon.
All the time.
That means for every minor blip in the global crypto market, BMNR's intrinsic value swings by over $500 million. That translates to nearly $1 per share in value, gained or lost, just on normal, everyday market volatility.
It's staggering when you look at the daily charts.
It's like buying a sprawling mansion on a highly volatile variable mortgage, where the bank physically checks the value of your house every single afternoon.
Yeah, that's exactly what it feels like.
If the neighborhood property values take a hit at 2 p.m., the bank is knocking on your door at 3 p.m. demanding you hand over the keys or a briefcase of cash to cover the difference. It sounds like a minute-by-minute collateral trap.
That variable mortgage analogy is incredibly apt, and we actually have a recent real-world example of that exact collateral trap springing shut.
Oh, we do?
Yes. Despite their large cash reserves, BMNR recently faced a sudden $17 million margin call from their institutional lenders.
A margin call?
Yes. And to satisfy that call, they were forced to dump 4,375 Ethereum tokens directly onto the open market at depressed prices.
Wait, hold on. Let me challenge that directly.
Go for it.
You just told me a few minutes ago that they have minimal liabilities, a current ratio over 30, and $268 million in cash and marketable securities sitting in the bank.
I did.
How on earth does a company with that much raw liquidity get forced into a margin call where they have to liquidate their core Treasury assets? Doesn't a margin call inherently prove that they are playing a dangerously over-leveraged game?
This raises an important question about how corporate liquidity and borrowing actually function in the institutional crypto space.
Okay, explain it to me.
Having $268 million in cash on the corporate balance sheet does not mean that cash is instantly accessible or legally cleared to be used as collateral for specific trading accounts or credit facilities.
Okay. The money's locked up elsewhere.
Often, institutional crypto borrowing is collateralized directly by the crypto itself. When the price of Ethereum drops sharply, the lender's algorithms demand more collateral immediately to maintain the loan-to-value ratios.
So the computers are calling in the loan.
Right. And if the corporate cash is tied up in MMAN infrastructure buildouts or sitting in segregated accounts that take 48 hours to clear, the absolute fastest, most legally straightforward way to satisfy the lender's demand is to liquidate the very asset that is dropping in price.
Which is painful.
Very. It highlights the acute structural liquidity risks of a leveraged crypto strategy. Even a company that appears incredibly cash-rich on a quarterly balance sheet can be subjected to brutal, automated margin calls.
That is a critical operational nuance. It isn't just about having the money. It's about where the money is sitting when the alarm bells ring.
Precisely.
And this ties perfectly into the broader macroeconomic headwinds BMNR is facing. Our analysis points out that the legislative odds of the Clarity Act passing are steadily falling.
Which is a big deal.
Right. The Clarity Act was supposed to provide a desperately needed, stable regulatory framework for crypto in the United States. Without it, companies like BMNR operate in a gray area.
And markets hate uncertainty.
Exactly. On top of that, Federal Reserve interest rate policies remain a huge wild card. If the Fed decides to keep interest rates higher for longer to fight inflation, capital becomes expensive, and risk on assets like Ethereum tend to suffer as investors flee to safer yields like Treasury bonds.
Absolutely. The macroeconomic environment regulation and interest rates acts as the ceiling on this stock right now. But as analysts, we have to balance that structural risk against the technical projections and BMNR's operational buffer.
Right, the shock absorbers.
Yeah. While the $17 million margin call is a glaring warning sign of leverage risk, the company's technical advisors, specifically Tom DeMark of DeMark Analytics, are modeling near-term upside targets.
What are they looking at?
Based on historical post-crash chart comparisons, DeMark's models see Ethereum clearing the $2,000 and $2,500 levels in the near term.
So they see a bounce coming.
Furthermore, we have to factor in that $254 million in annualized staking revenue we talked about. That cash flow acts as a massive fundamental shock absorber for the company.
Because it's guaranteed yield.
Exactly. Even if the spot price of Ethereum struggles to break out, BMNR is still generating $250 million a year in yield just by providing security to the network. That internal revenue stream provides a powerful defense mechanism against pure sentiment-driven panic selling.
So, bringing all these complex threads together, what is the final verdict for you listening? Based on the deep dive into these financial filings, the analyst reports, and the underlying mechanics of their validator pivot, our data yields a bullish score of 7 out of 10.
7 out of 10.
But with a very specific bolded caveat. This is absolutely not a sleepy buy and hold dividend stock that you ignore for a decade.
No, definitely not.
The opportunity outlined here is a high volatility swing trade geared for a 3 to 6 month horizon. The entire investment thesis rests on a concept called reversion to the mean.
Right.
You're essentially betting that the gap between the struggling market price of the stock and the underlying asset value, that NAV discount we discussed, will eventually close. And you are betting that it will be driven forcefully closed by management's $4 billion buyback program and a broader stabilization in the global crypto market.
It is a calculated bet on the raw math of the balance sheet, eventually overpowering the negative sentiment of institutional rotation.
Well said.
But before we wrap up today's analysis, I want to leave you with a broader, perhaps more philosophical question to mull over on your own time.
Oh, I love these.
As we discussed, Bitmine Immersion Technologies now controls almost 5% of all the Ethereum in the world. Ethereum, in the broader crypto movement, was built on the fundamental ethos of decentralization, a financial network owned by everyone and controlled by no single entity.
Right, power to the people.
But as cryptocurrency becomes increasingly embedded in the architecture of traditional global finance, what are the long-term implications when a single, centralized, publicly traded corporate entity wields more validation influence over a supposedly decentralized network than some sovereign nations?
Right.
It is a structural tension that the entire crypto space is going to have to reckon with very soon.
It's a brilliant question, and one that completely changes how we think about the future architecture of digital money. Are we just replacing traditional banks with digital corporate monoliths? Thank you for joining us on this deep dive into the fascinating high-stakes world of BMNR. We hope this exploration gave you the context and the mechanics you need to navigate these complex markets. Until next time, keep questioning the numbers and keep diving deep.